Is your retirement hanging in the balance of this year's election? You might be shocked by what the facts reveal about the stock market's performance under different political parties. Stay tuned until the end to uncover how this year's election could impact your financial future and learn a strategy that works no matter who wins the White House. Today, we're diving deep into a topic that's on everyone's mind as we approach another pivotal election year. How does the stock market perform under Republican versus Democratic presidents? Now, before you roll your eyes thinking this is just another partisan piece, let me assure you, we're sticking strictly to the facts here. My goal is to help you make the best decisions for your financial future, regardless of which side of the political aisle you find yourself on. Let's start by busting a common myth that's been floating around for years. Many people believe the stock market performs best during election years because politicians are working overtime to keep voters happy and the economy humming. While there's a kernel of truth to this idea, it's not the whole story, not by a long shot. When we look at the data, we find that election years are actually the second best performing years in the presidential cycle. During election years, the stock market is positive over 80% of the time. That's pretty impressive, right? But here's where it gets really interesting. The best year for stocks isn't the election year at all. It's the third year of a presidency when the market is up over 90% of the time. Talk about a plot twist. Now let's break down the 4-year presidential cycle to give you a complete picture. The first year of a new presidency is actually the worst for stocks. The market is only up about 57% of the time in year one, which means it's down a whopping 43% of the time. The second year isn't much better, with the market up about 65% of the time. Then we have that golden third year, followed by the election year, bringing up the rear of the positive years. So why is this important for your retirement planning? Well, it suggests that trying to time the market based solely on the election cycle might not be the most effective strategy. But don't worry, we're just getting started with our analysis. Now let's look at how the market performs under different parties. We're going to go way back to 1928 to get a comprehensive view. Buckle up, because we're about to take a roller coaster ride through nearly a century of market data. Starting with Herbert Hoover and moving through the decades, we see a fascinating pattern emerge. During election years, the market has historically performed better when a Republican is elected, with average returns of 15.3% compared to 7.6% for Democrats. That's nearly double. But before you rush to conclude that Republican presidents are better for your portfolio, hang on tight. We're about to flip this script. When we zoom out and look at entire presidential terms, not just election years, a very different picture emerges. Let's consider what would happen if you had invested $10,000 back in 1950 and only kept your money in the market during Republican presidencies, moving to cash when a Democrat was in office. By March 2024, your initial investment would have grown to about $80,000. Not too shabby, right? But what if you had done the opposite? Only investing during Democratic presidencies and moving to cash when a Republican was in office? Hold on to your hats, because that same $10,000 would have ballooned to over $400,000. That's a 5-fold difference. Now I can almost hear some of you cheering and others groaning. But remember, I promised something for everyone to like and dislike, regardless of your political leanings. And we're not done yet. There's a crucial piece of information coming up that might change your entire perspective on investing and politics. Before we get to that, let's break down the numbers even further. When we look at annualized returns, Republican presidencies have yielded about 2.8% per year, while Democratic presidencies have seen 5.11%. That's a significant difference, but it's important to note that these are averages over many decades and don't necessarily predict future performance. Now here's where things get really interesting. The stock market doesn't exist in a political vacuum. The composition of Congress plays a huge role too. So let's look at how the market performs under different combinations of presidential and congressional control. When we have a Democratic president and both houses of Congress are Democratic, the market has returned an average of 8.72% annually. Not bad at all. But when there's a Democratic president and a split Congress, one party controlling the House and the other controlling the Senate, returns skyrocket to 16.4%. And when there's a Democratic president with Republicans controlling both houses of Congress, returns are nearly as high at 14.5%. What about under Republican presidents? Well, if a Republican is in the White House and Democrats control both houses of Congress, returns have been a meager 1% annually. But with a split Congress, that jumps to 12.2%. And when Republicans control both the presidency and all of Congress, returns average 11.7%. Are you noticing a pattern here? It seems that historically, the market performs best when there's divided government, regardless of which party holds the presidency. This suggests that the checks and balances built into our political system might be good, not just for democracy, but for your portfolio too. But here's the kicker. And pay very close attention because this is absolutely crucial for your retirement strategy. Remember those scenarios where we only invested during one party's presidencies? Well, what if instead of trying to time the market based on which party is in power, you simply stayed invested the entire time, through Republican and Democratic administrations alike? If you had done that, starting with that same $10,000 in 1950, by March 2024, your investment would have grown to over $3 million. That's more than 7 times what you'd have if you only invested during Democratic presidencies, and a staggering 37 times what you'd have if you only invested during Republican terms. Let that sink in for a moment. By simply staying invested and ignoring the political noise, you could have multiplied your money by a factor of 300 over this period. This, my friends, is the power of long-term investing and the danger of trying to time the market based on political factors. So, what does all this mean for your retirement planning? Here's the big takeaway. Trying to time the market based on election results or which party is in power is likely to hurt your returns in the long run. The key to building wealth over time is to have a well-thought-out asset allocation and stick with it, regardless of who's in the White House or which party controls Congress. Now, you might be wondering why the market tends to go up over the long term, regardless of which party is in power. The answer lies in the incredible ingenuity and resilience of American businesses. Over time, companies consistently find ways to innovate, improve efficiency, and increase profitability. This ongoing growth in earnings and productivity is what drives stock market returns over the long haul, not short-term political shifts. Think about all the technological advancements we've seen over the past few decades. The rise of personal computers, the internet, smartphones, artificial intelligence. These innovations have created entirely new industries and revolutionized existing ones, driving economic growth and stock market returns, regardless of which party was in power at the time. Of course, this doesn't mean that politics doesn't matter at all for the economy or the stock market. Government policies on taxes, regulations, trade, and other issues can certainly have an impact on businesses and investors. But the data suggests that these impacts are often overstated, at least when it comes to long-term stock market performance. Now, I know we've covered a lot of ground here, and you might be wondering how to apply all this information to your own financial strategy. The most important thing is to have a long-term plan that you can stick with through different political and economic cycles. Don't let election year jitters or political biases derail your retirement goals. Instead, focus on making consistently good financial decisions. This means having a diversified portfolio that includes a mix of stocks, bonds, and other assets appropriate for your age and risk tolerance. It means regularly contributing to your retirement accounts, taking advantage of any employer match on your 401k, and maximizing tax-advantaged savings vehicles like IRAs. It also means staying invested for the long haul, even when the market gets volatile. Remember, time in the market beats timing the market every time. The data we've looked at today shows this principle in action. Those who stayed invested through all political cycles came out far ahead of those who tried to time the market based on which party was in power. Now let's talk about how to put this into practice. First, if you don't already have one, create a long-term investment plan. This should take into account your age, your retirement goals, your risk tolerance, and your overall financial situation. If you're not sure how to do this, consider consulting with a financial advisor who can help you create a personalized plan. Next, automate your investments as much as possible. Set up regular contributions to your 401k or IRA so you're consistently investing regardless of what's happening in the political world or the stock market. This strategy, known as dollar-cost averaging, can help smooth out the ups and downs of the market over time. It's also important to regularly rebalance your portfolio. This means adjusting your asset allocation back to your target percentages, which helps ensure you're not taking on too much or too little risk as different parts of your portfolio grow at different rates. Another key strategy is to educate yourself about investing in the financial markets. The more you understand about how markets work and what drives long-term returns, the less likely you are to be swayed by short-term events or political rhetoric. Read books, follow reputable financial news sources, and consider taking some online courses on investing and personal finance. Now, before we wrap up, I want to address one more important point. While we've focused on investment returns today, it's also crucial to acknowledge the growing issue of income inequality in our country. A strong middle class has historically been a cornerstone of American prosperity, and finding ways to support and grow this middle class should be a priority for all of us, regardless of political affiliation. This is where your role as an informed citizen comes into play. While the stock market might perform well under various political configurations, that doesn't necessarily mean all Americans are benefiting equally. As you make decisions about your investments and your vote, consider not just what might be best for your personal portfolio, but also what policies might help create a more equitable and prosperous society for all. Remember, a rising tide lifts all boats. A strong, broad-based economy with a healthy middle class is likely to be good for the stock market and your retirement savings in the long run. To sum up, here are the key takeaways from our deep dive into politics and the stock market. 1. The stock market has historically performed well under both Republican and Democratic administrations, with some differences in returns. 2. Trying to time the market based on which party is in power is likely to lead to lower returns compared to staying invested consistently. 3. The best returns have often come during periods of divided government, suggesting that political checks and balances might be good for the market. 4. Long-term factors like technological innovation and productivity growth are more important drivers of stock market returns than short-term political shifts. 5. The most effective strategy for most investors is to develop a sound, long-term investment plan and stick to it regardless of the political climate. 6. While focusing on your personal finances, it's also important to consider broader economic issues like income inequality and the health of the middle class. As we approach another election year, remember that your financial journey is unique to you. While the data we've discussed today can inform your strategy, it's always a good idea to consult with a fiduciary financial advisor who can tailor advice to your specific situation. I hope this video has given you some food for thought and helped you see beyond the political noise when it comes to your investments. Remember, a well-planned, consistent approach is your best bet for a secure retirement, no matter who's in office. By arming yourself with this knowledge, you're already ahead of the game when it comes to securing your financial future. Keep learning, stay consistent, and don't let short-term political events knock you off course. Want to know the best retirement planning tips? Watch this video next.